You may have heard people saying that you can never have too much cash or that cash is the only risk-free investment. As these statements appear to make logical sense, they will often go unchallenged. The problem is, though, when it comes to long-term investing, these seemingly logical statements are totally incorrect. The issue stems from the difference in how losses in investments such as equities and bonds are much more apparent than losses in cash. As an example, let's say David has two main investment pots, a £100,000 equity portfolio and £100,000 in cash. Over the 10-year period, David reads, listens and consumes every bit of investment information he can and manages to achieve a return of 20% ahead of inflation on this equity portfolio. This leaves him able to buy an additional £20,000 worth of goods than he could at the outset. Unfortunately, as David was so focused on his share portfolio, he forgot to think about his other sizable investment, cash. Over the same 10-year period, the effect of inflation was also 20%. However, inflation increases the cost of purchases, so this means that despite the cash amount, in pounds, remaining unchanged at 100,000, the value of that in terms of what it will buy at the end of the period now equates to only 80. In the end, David's purchasing power actually reduced by the same amount on his cash assets due to inflation as that by which it increased on his portfolio. It was just less obvious. This is why inflation is sometimes called the invisible threat or a risk to cash assets. Cash is particularly at risk as it is one of those assets that has historically demonstrated limited potential to earn a return in excess of inflation, as its returns derive solely from the rate of interest paid. However, this example should not be taken to mean that you should never hold cash. There is a danger to that as well. If life throws an unexpectedly large bill at you, beyond what you have available in cash, and you need to sell some of your investments to meet it, you may have to accept a lower price for them to generate the required funds quickly enough. If, for example, you had to meet an unexpected medical expense during the 2008 financial crisis, and all of your wealth had been tied up in equities, you may have had to accept realizing a substantial loss in order to extract the necessary cash to pay for it. As with most things in life, it is simply a matter of balance and there is no perfect answer. As a general rule of thumb, we suggest that you should try to keep sufficient accessible cash to fund up to 2 years of normal annual expenditure to the extent that this cannot be funded from anticipated earnings and/or pension income. In addition, we suggest that your cash reserve should hold sufficient funds to meet other known capital expenses due over the next 5 years. However, you may be comfortable with more or less than this, so it is only a starting point for discussion. For more information about investing, please see the Bloomsbury Guide to Investing or reach out to us directly.